Hey, on today's show, The Final Bar, we're going to talk market pullback. We've talked about some of the warning signs, some of the issues leading up to this Monday. Seems like we've had the follow-through we've been talking about for quite a while. So the bearish divergences sort of playing out, sell-off across the board. We're going to talk from a big picture perspective, what this means for the long-term trajectory of the S&P 500. On a sector level, do a sector setup section where we talk about strength and weakness across sectors, and then shifting stocks, what's moving, what's working, what isn't. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Happy Monday. Quite a day, market-wise. So what we're going to do today is sort of debrief on how things happen, right? What the short-term movements mean relative to the long-term trends. We always talk on the show about the importance of connecting the short-term to the long-term. On a day like today, more than ever, very important to be paying attention. You know, as we've talked about before on the show, you know, at the day of a sell-off is not the time to be developing your exit strategy. So hopefully, this is not a source of anxiety. You've got sort of the lines in the sand, the levels that you're watching, the signals that you would pay attention to take action or to get defensive or take profits, whatever you like. So, but we'll hopefully try to fill in some of those blanks today. So we're going to talk about the market sell-off, look at the big picture. We're going to look at sector rotation, then we're going to look at stocks. Should be pretty interesting 30 minutes together debriefing on the markets. Before we get to that, though, I did want to talk to you about the schedule coming up in the next couple weeks here on StockCharts TV, in particular the Final Bar. Today, we actually, on Behind the Charts, which is our interview-style show, we interviewed Craig Johnson from Piper Sandler. Just released his interview today, so you'll see it later on our YouTube channel. Next week, we actually have our interview with Fred Meisner from the Fred Report based in Atlanta. That'll be next Monday. Later in this week, on Wednesday, we have Julius DeKempener, king of the RRG, joining us on this show to share his themes on sector rotation. Then Axel Kavar, who's a Bulgarian technical analyst, on Thursday. Should be a very interesting, different perspective than we normally had. The week after, we have Scott Smith on March 3rd. He's from Briefing.com. And then we're going to be heading on the road. So we are going to the Traders Expo in New York, which is in Brooklyn this year. If you are thinking about attending, I hope you'll take a look at the website, check out my presentation. And if you do get there, please make sure you attend my presentation and would you say hello to me afterwards. I'd love to meet you in person. But should be a really cool event. And also, while we're there, we're going to be capturing some fantastic interviews with some of the other speakers. So a lot of really cool content that we'll be getting to your way later this week, this month, this year. Let's talk about a market recap. So as we mentioned in the introduction, you know, clearly a lot of distribution during the day today. We're going to start on a chart of the daily S&P. You know, I don't feel any joy in being validated on these big bearish divergences that appear to have played out. That is not a happy thing, but certainly a lot of these signals we've seen about weakening breadth, about negative divergence, certainly seem to capitulate into what we saw today. And we talked on Thursday and Friday about the beginning of that distribution and what sort of follow through we'd get. I think we sort of have our answer today from a technical perspective with the big sell-off. We've talked a lot, and we talked a number of times in the last couple months really about 3210, which is the low from the end of December, the low from the beginning of January, and that was the retest that we had the last week in January. And don't look now, but almost to the penny, we hit that level today. We closed lower than the open, so certainly, you know, distributive going, you know, through the course of the trading day. But overall, we're right at that line in the sand. We've broken below the 50-day, but we're holding that support level. So now that we've broken down, now that we have a chance in the rest of this week to digest what just happened, that's the real question now. Is this support level hold? At which case I would argue the long-term charts still are in the more constructive versus destructive mode. There's still long-term uptrends. Or is this the first of a series of legs down, in which case we would break that 3210 level, and then I think you really have to reconsider offensive positioning, think more defensive, think more about capital preservation. The RSI broke below 40. We've talked about that a lot, about what that means. And again, on a closing basis, we're actually identical to the close we had that last week in January. So tomorrow, the rest of this week, really, really key to see what sort of follow through we have there. But overall, I think this is the beginning of more of a digestion of these gains that we've had, a follow through on the negative divergences we've seen. From a top-down perspective, this is fairly destructive by any measure. The S&P down over 3%, 3.33%. Mid-caps and small caps not down as much. So it was really led by the biggest names. And if you look over at the sector, energy down the most, but technology right above there. So energy down almost 5%, tech just over 4%, followed by consumer discretionary. On the upside, everything was down, but utilities and real estate down the least, followed by consumer staples. So this is certainly a follow through, rotating away from equities in general, but especially away from the offensive side of the ledger, getting out of those offensive sectors. We're going to talk a little later in the show about sector setups. We're going to think about some of the rotation and what sort of short-term lessons we can draw from that. I'm really excited to have Julius on the show this Wednesday. I know he'll be definitely ready to share some thoughts on that. When we look at global markets, it's interesting. Singapore, the China A-shares ETFs were two of the ones that were down the least, followed by Canada, but all down a good amount. Those are all down 2-ish%. At the bottom side, you had some things that are down much more significantly. So Italy and South Korea, the big news are related to the coronavirus coming from those two regions and their challenges dealing with the spread of the coronavirus. So understandably, those are down fairly significantly here, followed by the more commodity-oriented markets like Russia, Brazil, really tied to the price of oil that got hurt pretty quickly today. In terms of industry movements, we've got gold stocks and mining stocks as the only two groups that were up. I want to show the chart of gold here, though, quickly, because it wasn't necessarily all positive. Even though there was an up move in the GLD, you can see it ended up being a little more distributive. So it might be hard to see the far right corner here. If we just zoom into 1 year. Here we go. So if you look at the far right side here, you can see the distribution. So a big gap up. The GLD got above 158, and it felt like, oh man, this thing's going vertical. This thing's going to go to 200 today, right? I mean, it's rallying so quickly. But if you look during the course of the day, it actually settled down very nicely. So even though continuing to follow the stepwise motion higher, the initial rally, the initial gap up, sort of was a little too far too quick and settled back down just above 156. So in the short term, actually showing some distribution going into toward the close. It wasn't all positive. And mining stocks and gold stocks in particular looked a lot like the chart of the GLD. A big gap up, but in the end closed down. What's interesting about the GLD is even with that distribution during the day, the gap higher pushed the RSI into the extreme overbought region. As we've talked a lot, it looks back like the first week in January, looks a lot like last June where you had the extreme move up, the gap higher, and then a bearish divergence, but that extreme overbought region was a signal that there were more further highs to come, and I would expect that similar sort of pattern to what we saw there with gold. I wanted to switch and talk about bonds as well, because we're going to get a lot deeper into the equity markets. So I want to make sure we covered some of these other markets and how they reacted to today's sell-off. So certainly a flight to safety in form of gold, but also in the form of bonds. So bond prices up pretty significantly. Same pattern though. The TLT gapped up significantly up to around 151. By the close, got right back down to that 150 level, but certainly is following through this rotation, this digestion of the rally, this break to new highs in the last week and a half has certainly been stronger on the TLT. The last thing I want to show you before we get to our next segment is looking at the VIX. I know a lot of people pay attention to the VIX, the fear index, and if you look, the VIX finished just above 25. That puts it in the same range that we saw in August, which was this big sell-off here, back last October of 2018, which was the first sell-off in the first week of October. Those are all those initial moves. The challenge I have with saying the VIX is so high that it lines up with some of these previous corrective bottoming patterns is because the VIX can go way higher. We always say don't confuse the top of the page with resistance. Just because the VIX has gone up a lot doesn't mean it can't go up way more. And if you look back here in December, if you thought, okay, the VIX is at 25, that means we're bottoming, we went a lot further down. The VIX spiked a lot further up into the upper 30s. before there was any sort of bottoming pattern. So I don't think the fact that the VIX is that high tells you that that's it, tells you that there's a capitulation. It just tells you that the fear has increased, the volatility has increased. There could be much more of a sell-off here, and it will, looking back in the rearview mirror, it will make plenty of sense later. So certainly something to pay attention to. I'm always cautionary about the predictive value of the VIX hitting a certain level because it can go much, much further before a bottoming pattern sort of continues. I want to move on to our next segment, shifting stocks. So on a day like this, when you have big distribution, there are a couple things you like to look at. You like to look at the themes underneath the hood, right? What's really driving things up and down? What stocks are working? Which ones are not working? And again, on a day like today, it feels like sort of everything's down, which is on average pretty much about right. When I'm thinking of shifting stocks, I think of this candle glance page of the Dow members, and if you look and just look at the last bar here, the final bar, you can see pretty much everything down, but there are some notable places where there's some outliers, stocks that did not really sell off. And if you just look at the Dow members, you could probably see some of the things that jump out at you. This is where I want to start. Number one, Coca-Cola. So this is a stock that was down 2.5%, so not too bad, but overall the trend's still pretty much in decent shape, and on a relative basis, still testing a new relative high, even with the sell-off today. So even though the market was down, a lot of staples names actually held up okay. Home Depot's another one, and again, down over 2%, but the market was down a lot more than that. So on a relative basis, still holding up pretty well. And again, that short-term pullback is still not too bad of a trend. It's sort of at the lower end of a trend channel. Even if you connect the lows using a trend line, you're still actually holding up okay. So I'm interested in names like that, everything sort of pulled back, but things that did not pull back anywhere near as significantly. I'm also very intrigued by a stock like McDonald's, which gapped down along with everything else, but actually showed accumulation during the day. So even though it closed below yesterday's close or below Friday's close, it closed well above the open. So there was accumulation, people buying into that weakness. It finished down 1%, but again, on a day when the S&P is down over 3%, something down only 1% is actually pretty compelling. And the fact that the relative strength now testing a new 3-month high, and that 13-week or that 65-day high is something that I always am looking for, new breakouts, new breakdowns, especially on a relative basis. Something in this environment that's breaking to a new, quarterly high on a relative basis tells you that there might be some opportunity to find safety in those sort of names. Walmart has been a stock that's been certainly on a lot of people's sort of negative radar. They had the news last week that felt much more negative than positive, but if you look today, pulled back, but overall actually within this huge demand area, an area at which buyers have come in before on a relative basis to a new 2-month high today as it held up okay, down just under 2%, while most things were down a lot further. So just within the Dow names, something like the candle glance page can be interesting to sort of see what held up pretty well. It's also interesting to look at things like Intel, things like Johnson & Johnson, and these sorts of names that have pulled back to a significant key price level, right? Something like the 50-day moving average. We've talked about breadth and the number of the percent of stocks below their 50-day. A lot of names like Apple breaking below them today on the big selling across the board. But overall, if names like Intel or Johnson & Johnson are able to hold the 50-day, that might tell you, perhaps the pain won't be as negative as you might expect after a day like today. So what actually was doing okay on a day when everything was down? Let's go through some of the names that are the biggest gainers on the Scooter rankings. And again, this is a percentile ranking. So just because the Scooter ranking has improved doesn't mean the stock wasn't down. It certainly could have been, because this is all about its movements relative to everything else. So it's really more based on the relative strength of those movements, not just on the price movements themselves. Gilead is one name that actually gapped up today, up almost, just over 4.5%. Traded off a little bit, I think, as, along with everything else, but overall a nice jump higher. It's actually overbought at a time when very few names feel like they're going to be overbought here in the near future. You see a lot of staples in here, so something like Clorox comes to mind. This is in non-durable home products. But again, what I'm interested with a chart like Clorox is if you did not know what a sell-off we had today, if you were just looking at this chart, just doing it from a purely technical perspective, what would you say? You'd probably say, well, this is a nice rounding, bottoming pattern, almost a cup and handle-like pattern, even though the highs are not perfectly lined up. It's not too bad. So we sort of hit this resistance level around 164, traded above there, now have a shallower pullback. Now retesting, aiming back toward those highs at 169. So charts where you wouldn't know that the market has sold off aggressively today, if it's not obvious on the chart, it tells you that something might be there. So something like Clorox, certainly more of a safe haven, something that's setting up pretty constructively in a time when things are relatively weak. You also see stocks like Campbell's, which have been fairly beaten down, coming up pretty nicely, but although, again, coming out of fairly weak levels. I thought it was really interesting to see some of these exchanges, things like CME and others. You could argue this might be because of there's going to be a lot of volume on exchanges as people sort of, are figuring out how to manage the risk side of things. Anything with an options exchange is probably going to do pretty well because that's where people are potentially going to want to hedge the downside risk. So something like the CME, again, holding really nicely on the 50-day, actually closing up on the day, just 0.25%, but accumulation during the day closing above the open. That's actually fairly constructive. On a relative basis, still pretty flat for the last couple of weeks, but if you see a deeper sell-off, something like CME that's holding up okay could actually be really, really, really interesting. I did want to look very quickly at some of these groups now. Gold miners and mining stocks are the two groups that are up, two of the only groups that are up today, looking at our Dow industries of 105, I think, different industry groups. These are pretty specific groups of names, and gold mining stocks and the mining group are the two that were up. The gold miners, similar to the chart of the GLD, they gapped higher. They closed below the open, but above yesterday's close, so up over 1.5%. You can see the GLD was extremely overbought. The gold mining index, not quite there, but very, very close. So it feels very similar to what we saw here at the end of December, where you had the nice rally higher, bit of a pullback. That's normal when something's overbought, but the extreme overbought reading, if we can get above 80, sort of suggests a bit of a pullback before resumption of the upside. And again, all else being equal, if we see a deeper sell-off, you'd most likely see some of the gold mining stocks doing pretty well in concert with gold in general. On the downside, you're going to see a lot of familiar groups that kind of make sense. So you have automobiles. This is Tesla's group. Airlines, which is a bit of a concern. Thinking about the transportation index and Dow theory. Gambling. These are a lot of names. Hotels. There's a lot of luxury types of companies with a lot of ties to Asian tourism. So that's going to certainly be some trouble. And then a lot of energy-related groups, obviously down as well. And it's interesting. The E&P stocks. Now, these are exploration and production names. With energy, we've talked about that potential for energy to recover. And as of Friday, I remember looking at this exact chart and thinking, okay, it's sold off. We're near the previous lows. We're sort of in this consolidation pattern. This can resolve one of two ways. Either it breaks above the previous high or breaks below the previous low. Today, we've gotten that signal, and it's sort of breaking down to the downside. So when we think about shifting stocks, again, it's all about these little moving parts. I would remind you, no matter what the broad market does, there are always some opportunities for stocks that are up. So on a day like today, look at which stocks are going higher, look at which stocks are not going down as much. So anything on this first page, things like Brewers, Waste Disposal Services, a lot of the real estate groups, these are names that are holding up okay. They're still selling up, but not nearly as badly as you may have seen elsewhere. And I would also remind you, I think the best charts to consider right now are the ones like a Clorox, for example, that we looked at, that if you didn't know that the market had sold off today, it's not obvious on that chart. This is a stock that is resilient at a time when most things, I would argue, don't feel that way. So those are some opportunities to think about where the assets might be shifting toward. Folks, we're going to take a quick commercial break. We're going to be back continuing this mental processing of the sell-off today with a sector setup segment. So we'll see you in a minute. Hey everyone, welcome back to today's show, The Final Bar. Thanks for joining us every weekday after the close to digest today's technical action connected to the long-term trends. No better time to do it than on a day like today when we have some real volatility, some real movements, and it's all about where do we go next. I think charts are the best way to measure where we've come and start to make a probabilistic assessment of where we might go to next. Please keep your questions, your feedback coming. We've had so many great questions recently asking about market movements, asking about specific stocks and sectors, technical analysis, and also market structure. I'm getting questions about different types of financial firms, banks, and so forth, and anything is fair game. I will do my best to answer those based on my own experiences. So shoot your questions to us at thefinalbar@stockcharts.com. We'll get to them in a future mailbag segment. Our next segment is called Sector Setups. One of the things we like to do is think about sector rotation and what that means for you, especially on a day like today when we've had this feeling of rotation toward the defensive side of the ledger. And then what does that mean? So I wanted to get to first the RRG, the relative rotation graphs. My guest on Wednesday on the show is going to be Julius DeKempener. Really excited to hear how he's processing today and the 2 days next to see what it means for his view on the relative movement of stocks. But I'll give you sort of my take. This is a chart that I look at every day, and certainly part of my weekly routine is to look at the weekly RRG. And the idea is this overall general rotation of assets from strength to weakness. And the technology sector, the XLK, has been a consistent member of the leading quadrant, at times the only sector it felt like over there, and had been going northeast forever. So while so many things were rotating lower, things like energy, materials, industrials, consumer sectors, consumer discretionary, technology has been sort of the lone positive signal. That's starting to change now. And if you look at the daily rotation, it's obviously much more severe because it's based on the short-term movements. But I think it's interesting to see on the weekly basis, this last week has really pushed technology sort of down. That means the momentum's slowing down a little bit. In general, northeast is good, southwest is bad. That's my cheat sheet for how to use RRG. So if it starts to rotate down southwest, even if it doesn't get to the weakening and lagging quadrants, it tells you that the momentum is coming out and it's starting to underperform. Furthest to the right still means it's been the relative outperformer, and the relative strength has certainly been strong with tech. You can see how we've rotated away from healthcare and financials. Financials have been one of the worst on a sector basis. Just looking at the breakdowns on some of those charts that have certainly followed through today from the end of last week. The XLF now firmly in the lagging quadrant. The biggest, most weak sector has been the XLE. Energy has certainly been a stay away on the relative rotation graph work. So what has looked interesting? A couple things: utilities, consumer discretionary, real estate. These two make sense. The defensive groups like Utes and real estate, the XLP heading northeast as well, which kind of makes sense. Consumer discretionary is an interesting one. A lot of this is Amazon, which is a huge weight in the XLY, which is certainly cap weighted. So if Amazon is doing well, this sector is going to look pretty good on a relative basis. I think if you take the weight of Amazon out there, it's a little less attractive, but overall still holding up okay. Communication services is okay. It's sort of a mixed bag, though. You have some offense. You've got media names, but you've got the old telecoms in there. You've got tower stocks. It's sort of a mishmash of things, and so it's pretty close to home. It's pretty close to that benchmark reading. So not a huge signal one way or the other. The next step I like to follow looking at sector rotation is doing the candle glance, and especially on a day like today when everything has sort of moved lower, the question is, where are we at relative to the most meaningful level? So I always say start with the final bar and look to the left, right? So start where we're at today, look to the left. Where are we at relative to any key support and resistance levels? So on a sell-off today, like today, where are we at relative to any key support levels? Are we holding support? Are we starting to break down? One of the things we've talked about in previous segments on sector rotation is how most sectors, if not almost all of them, have been above their moving averages, above upward sloping moving averages, which tends to be a good sign. And last time we did this, most of the sectors, with the exception of energy, were above upward sloping 50-day moving averages. That has all changed very quickly, folks. So if we look communication services, consumer discretionary, financials, healthcare, looking through these materials, industrials, these are all sectors that have now, as of today, rotated down through their 50-day moving averages. They've failed there. And so now the question is, where are they at relative to those previous swing lows? And a lot of them, like the XLF, if we zoom in here for a second, are testing that low from the mid-January low. That was that sort of pullback coming out of the new year. They rallied to new highs, but now we're back to those levels. On a closing basis, it's gone below the close from the middle of January, but it is sort of right at a horizontal line. If you drew a line here, we're sort of right at that support. So the question is, are we able to hold that or not? And I think that's the thing you want to pay attention to this week with a lot of these sectors, with healthcare, with industrials, with financials, with others. Are they able to hold those previous support levels? Communication services as well. With tech, it's actually right at the 50-day. It traded below it, but actually came back up there. And I would say consumer discretionary, maybe consumer staples for sure, right at an upward sloping 50-day moving average. And if those are able to hold, that would tell you they're holding up okay. Probably on a relative basis, they're going to be in fairly decent shape. But if they break down, that's certainly cause for concern. Energy is one outlier, a complete, stay away from a technical perspective. This reminds me of, don't confuse the bottom of the page with support. Just because something's gone down a lot doesn't mean it can't keep going, and that's what we're seeing with energy, a gap down, putting it to new lows on the XLE. It sort of suggests hold off until we get some sort of stabilization. Now we look at the defensive sectors, real estate and utilities, and these are the other real outliers, right? So something like the XLRE doesn't look too bad, and on a relative basis, you can see how it's starting to spike up because it's holding up at a time when all these other sectors are really starting to break down. Utilities are the other one that I would be paying attention to. Looking at these two sectors, they've both come off today. That's totally fine, but if you look at the relative strength, they're both making new 3-month relative highs today. So if that is able to hold through the week, it really suggests a movement to more defensive side, and with the dividend component, certainly feels like a safe haven to ride out some potential downside in stock. So when we think about sector rotation, again, I like to start with the RRG, looking at the big picture. A couple quick themes to remind you of. Number one, with all these sectors that have broken down through the 50-day, like communication services, like financials, look at where they're at relative to those swing lows last in January, and if they were able to hold or not. If they break them, I think you really want to start getting away from them if you can, or rotate away, think more defensively, think where you can ride things out a little further. Number two is if we see a continued outperformance from utilities and real estate, which are starting to potentially emerge there. And then staples, out of all of these, staples is a really interesting one because it tends to be a safe haven right at an upward sloping 50-day, and we'll see if that is able to hold or not. Ladies and gentlemen, we need to wrap up the show. On a down day, I tell you what, it's so much fun because there's a lot happening, but we do need to wrap the show with a 3 and 3. So here's 3 charts in 3 minutes. We're going to bang through these very quickly. Step number 1, Dow theory. So this is the traditional look at the Dow Industrials and the Dow Transports. As you can see with today's sell-off, both of these have now made a new swing low, a new closing low below the low from January. We talked about just with the charts of the sectors, whether they're able to hold it. The problem now from a Dow theory perspective, they've broken below those swing lows. Now, again, I've talked with a lot of my peers in the industry about the different methodologies to really think about Dow theory. I tend to keep it super simple. If both of these are making new highs and new lows, we're in an uptrend. If they're making lower highs and lower lows, we're in a downtrend. I now see transports with a lower high and a lower low. I see the Dow Industrials with a lower low and not yet a lower high. That would be the final piece to confirm a breakdown in Dow theory. Number 2 is EFA. This is the Global Developed Markets ETF. And as we can see here on the chart, it's just below an upward sloping 200-day moving average. There's a huge gap down because of the weaknesses in Italy and other European markets, just at the 200-day and just oversold. So the question is this a bottoming point? This lines up to where we had last summer and also last fall. So I think it's at a really key level. That's why I'm paying attention to that chart. And chart number 3 is the relative performance of utilities. As I mentioned, the rotation away from offense and into defense. If you see technology breakdown and utilities break up on a relative basis, and I would not pay as much attention of the price, I will look at the relative chart and see if that's able to hold. I think you're really potentially going to be on the right side of things, and make sure you're positioned well. Ladies and gentlemen, that's our show for today. Again, a sell-off like today is actually compelling. It's interesting because it allows you to really think about where we're at relative to all these key levels. When we're in an uptrend, it's sort of slow and steady up and to the right, everything's fine. When things sell off, we can really start to make some comparisons. And I think charts, looking at where we're at relative to where we've been, can be really helpful to understand what's holding up, what's breaking down. One thing we didn't really get to that I would encourage you to look at is a weekly chart of the S&P 500, that weekly MACD or the weekly PPO. just starting to break down, but I would caution you to not draw a conclusion until we get the weekly close on Friday. You'll see a potential sell signal. We need to get confirmation from the end of this week. So the next couple days, going to be really, really key. So stick with us this week on the Final Bar every weekday after the close so we can debrief on how this short-term correction lines up to the long-term trends. We've got some really good guests coming up this week, and I'd love to answer your questions in our mailbag segment. The Final Bar at StockCharts.com is always the best way to get your questions to us. If you miss any of our episodes, especially this week, trying to make sense of things, just go to our YouTube channel. They're all there. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.